So today, John and I are going to be breaking down the 5 ways that we select markets and selecting markets before they hit. We call them emerging markets before they boom. And so John and I are going to be breaking down the top 5 things that we look for in these hot markets today. John, it's great to be here with you.
So good to be here, Mark. It's such an interesting thing, right? It's the idea that you could have like a really quote unquote great deal, but it's in the wrong market and it's going to struggle. But you could effectively have like maybe a more okay to mediocre deal, but in the right market and it'll perform, right? So I would say the biggest factor is really the market. It's funny in our world, like at Faris Capital Partners, that's actually where I spend most of my time. We have an acquisitions team and they're really doing the deep analysis into the building itself. And then our asset manager gets involved. And kind of before I even see it, that process has already taken place. But then I step in and really digging into the market that the deal is in, and almost more importantly, the sub market that the deal's in, right? That idea that in real estate, location, location, location. So when we say sub market, we're kind of just saying the community or neighborhood, the little pocket, if you will. So if we think about Tampa, right? Metro Tampa, Largo is a submarket of Metro Tampa. So when we're buying a deal or looking at a deal in Largo, we're drilling down into that specific community and really going deep to understand the demand drivers of that particular area community. Then we go out to the broader area, right, to look at the overall demand drivers that are happening. And so, anyway, I love it. It's actually
Yeah.
one of just something I really enjoy doing. And having spent my whole career in real estate, right, what you learn is you can't pick the building up and move it. So if the area it's in has problems, your deal is going to have problems, right, at
Mm.
the end of the day.
Yeah, it's interesting, John. Like through the years, we've sold over 13,000 properties. And for many years, like at the end of the day, what drives values is like I didn't have the in-depth knowledge since starting Fair's Capital and really diving into what drives values. It was
Yeah.
something that it was like, okay, I understand, more jobs that helps. But then to really get granular as to what are the main things that actually are the biggest indicators if a market is going to boom or not. And so we're going to be diving into the top 5 things that we look for after going through that journey, and we're going to be coming back and we're going to be sharing that today.
Yeah.
The other thing that was really interesting, John, is that I always figured that I always had to just invest in my own backyard. So as you know, and for the listeners, uh, north of Toronto, Barrie, it's 150,000 population. That's kind of hometown for me.
Sure.
And so that market was a booming market for like a solid like 10 to 12 years. Like it was a great market, appreciating every year. Properties were cash flowing. It was really great. And then it stopped being great. Properties stopped cash flowing, and it's if you own your own home, it's still a good spot to own. But if you're going to be buying investment properties, this is a different. I look through it, buying these properties through a different lens, and so I want to be able to invest in an area. Not only am I going to be making money from day one, but it's going to be a very strong appreciating asset in the near and long term future. And so that's where I realized I didn't have to keep investing in my own backyard, but that took like a big paradigm shift for me, John, where it's like, of course I gotta invest in my own backyard. Like that's
Yeah.
the only spot. It's like, well, no, that's what you think is true. But the reality is if you have the right partners, you can invest anywhere in North America. And what's really cool is once you start building a team around and you start looking where are the best markets, all of a sudden it's like smack in your face. It's like, of course we'd invest in this market and we wouldn't invest in this market. But if you were living in that market, that's all that you know. And so this is where for us, we're able, John, as a full-time team of 9 in Fair's Capital, this isn't just you and I. We have a full-time team of 9 that we're able to zoom back and look at right across North America. Now, mind you, Canada and US, these are like the 2 markets that, we're able to look back on, and we're able to say, hey, listen, these are our markets that we want to go into because this is what the data is telling us that is going to be the strongest place to, invest not only on our personal capital, but our investors' capital to have the biggest upside, the biggest lift uh, and we're not tied to a single location as well. So that I think is such a major advantage. But John, I mean, we've talked about this. This was a major paradigm shift for me because I thought
Yeah.
I had to always invest my own backyard.
Well, and I think that's what's so cool about these types of investments, right? Whether with us or somebody else, right? The idea that, probably likely if you're buying your first rental property, having it closer to where you live makes sense, right? Because you want to be able to check on it and maybe you're self managing it and maybe there's some renovation involved. So you don't have to drive 5 hours or get on a plane or whatever to check on it. But that's, I think, what's so cool about this is that opportunity to invest in these emerging markets or these high growth markets, but you don't have to get on a plane or drive down and check on it. You've got a team of professionals behind the scenes making it happen. But yeah, there's really 5 ways that we think that you really need to analyze. And there's, maybe some nuance within these. So it's not just 5 things, but these are the 5 key ways that we select new markets or the best markets really to invest. No surprise, number one, it's going to be all about job and population growth trends, right? So we want to make sure we're buying in an area where we're seeing sustained job growth and in migration over a period of time. So in other words, not like a little blip or whatever, but going back into history, US Census data we look at. So what has the population trend look like over the past 10, 20 years? So we look at what's happened in the past 10 and what's projected to happen in the next 5. So I actually think about our newest deal in the Atlanta area in a little submarket called Newnan, where it's had 20% population growth in the last 10 years and is projected to have another 12% in the next 5. So that's like a ding ding, like this is a market we should be looking at and paying attention to. But beyond that, we also have to look at the economic growth. Are there going to be jobs to sustain that population growth? And then within that, is it a diverse set of economic drivers, right? So not just one industry. So going back to that Atlanta deal I just mentioned, we have Hitachi, Yamaha, but there's also Amazon, there's healthcare, the Piedmont healthcare system, which is massive in the state of Georgia, has hospitals and internal medicine and orthopedic doctors down there, so tons of jobs. And then you're also 30 minutes from Hartsfield-Jackson International Airport, the busiest airport in the world, and alongside that, all of Atlanta, right? So there's plenty of job opportunities. So it goes back to we start in the submarket and then we look at the broader market. So in this context, Newnan, and then we look at Atlanta. And so we're tracking what are those key employers, those industries, and that diversification within there. So even after we buy the investment, Mark, part of our quarterly updates, actually, I go into the various business chronicles and just see what's happening, right? So for example, on our Largo deal, there was actually a warehouse not too far from where our building was located that was vacant. And a pharmaceutical company just bought it and it's going to create 200 jobs, right? So we're even tracking it as we get into the deal just to see what's happening. But bottom line, we're investing where the people and the paychecks are going, right? Like just to put it simply, that's really what we're thinking about.
For sure. And the right kinds of paychecks as well.
Yeah.
Like we want jobs that are paying very high because when people can pay high, that means that our apartments in the B class space become very, very attractive. And
Mm.
that actually leads us to the next point is affordability. So affordability is an interesting thing because it can mean different things to different people. The reality is the way that we look at affordability is this ratio called the income to rent ratio. So what is the average income for an area compared to what is the average rent that is in an area? And so we look at that. And so when we're looking at an actual building to purchase, like Newnan, for example, the average income to rent ratio was actually is 25%. Now listen to this. We look at, okay, if an average income is, let's just say, for example, is 100,000, and we look at this building, say in Newnan, for example. So we look at that and we say, okay, what is the average after renovated rents? What is it in a year? And so we look at the building and the average income for an area, and we say, okay, once we renovate and then we increase rents, is it under 30%? In this building we're looking at right now that we're almost actually filled on this. It was a $12 million equity raise on this. We only launched it a few weeks ago, and we're going to be fully raised here within the next week or so. And so this is 25% of the average income to rent ratio. This means that it is extremely affordable. It means that people have more after, we'll say, rent funds. After they pay their rent, they have more funds in their pocket to go live their life. Now, you may not have context, and you if 25% is like, is that good or bad? Well,
Right.
here's an example. So Barrie, my hometown north of Toronto. So we're in Naples, Florida, a good part of the year. That's where I'm actually shooting this clip here. But in Barrie, north of Toronto, so it's about an hour north of Toronto, the average income to rent ratio is 50%.
Wow.
50%.
Yeah.
Toronto is 60%.
Yeah.
And New York is New York is 70%, the average income to rent ratio. And so you want to be able to be buying in areas that are affordable, because you don't want to be going in and like grinding your residents and taking every last penny that that they
Yeah.
have in their pocket. I don't want to be that type of landlord. I want to be a landlord where we can go in and add a lot of value, and then, increase rents to be able to, be properly compensated for the value we're providing, not only a roof over their head, but giving them great first class service. But I want them to be able to have a life as well. And so when you're buying in these areas that are affordable based on the income to rent ratio, it really allows you to operate in a more efficient manner. And it allows you to actually maybe push a little bit and get above what you had projected for your rent increases, while still being affordable for the residents that you have.
Yeah. And in a sense, too, right? When they have more money to spend, right, for other areas of life, recreation or whatever it might be, it's actually like a bit of a flywheel where money's now going back into that local economy, which in turn helps create more jobs and
Yes,
attracts
great
more
point. Yeah.
population, right? So, there's a lot of reasons, but that idea that we want to provide something that feels very luxurious, that first class service you mentioned, these incredible renovations we do, which takes, like a maybe a lower B or even a high C asset and turns it into a high B asset, right? A being new construction, right? Um, and that's actually a way we mitigate a little bit of risk, even for potential downturn, right, in the economy. So, say for example, there is a recession or something like that. Somebody who generally is maybe an A asset style renter will look to save, and they'll come down to our B level asset because once again, it feels the same. It's got all the same bells and whistles of those new units. So, the third thing is really that supply and demand balance, right? So it's really critical to get this right because we've seen operators that, bought a good deal and things were going well. And they didn't realize that, a mile away, 600 units were under development, right? Or were online coming soon, right? With permits being pulled. So really digging into the data. But, the reality is yes, CoStar is a great resource. That's one resource we use. We look at a lot of different other resources to kind of gauge that kind of supply that's coming online. But most importantly, what we do is we drive around because sometimes the data may be wrong, right? And so if you see a vacant piece of land and it's zoned residential, right? Let's look that up. I mean, I remember being up in South Carolina recently looking at our Georgetown deal that's closing in the next week or so. And we just saw a couple pieces of land available, and we were looking, we're like, it's probably commercial because of where it's located and it's like next to a shopping center, but let's just look it up. Let's look the zoning up. Let's figure out who owns it. Is there a world that could exist where this could become an apartment building that would compete with us, right? So that new construction pipeline, and then we're actually looking at absorption, right? So, for example, Florida is a market that's seen a lot of new supply, but it's actually
Yeah.
absorbing that supply very rapidly. Now, that's not true of all markets in Florida, but the ones we're looking at. So, it's not just enough to say, hey, there's no new supply or there's a lot of supply. You also have to look at the absorption rates. How many of those units are being absorbed? Because we do know that when there's overbuilding, rents will soften. And undersupply obviously creates upward pressure, right? So we're looking for a good balance. In a perfect world, yeah, it would be an area with no new construction coming online, which actually is why we like that deal in Georgetown, South Carolina. The population's growing, but there's nothing coming online soon. That Atlanta deal we've mentioned, we like that deal because the county that property sits in is restricting new multifamily buildings. What they're doing is called build to rent. So single family rentals or townhome rentals that come at a much higher average monthly rent. So kind of finding that balance of supply, demand, and the right kind of supply and the right kind of demand is super important. So it's about that healthy market, right? Not oversaturated,
Yeah.
right? So finding that balance.
Yeah, for sure. Next is being a landlord friendly market. Now, I'm a little sensitive to this one here, John, because I've had
Yeah.
my own experience, and it's interesting. I talk almost every day with investors that are like disheartened, they're tired, they're fed up, they feel violated. because, they have these rental properties, and a lot of times they're the previous homes that they lived in and they rented out to a
Yeah.
tenant.
There's like an emotional connection to the house. It
Emotional
made sense. Yeah.
connection,
Yeah.
and the existing tenant just stopped paying rent, and they're like, "Mark, this tenant has been there for 12 months and I cannot get him out. I cannot get him out." And he's living there for free. And, the landlord tenant board has taken now 12 to 18 months to evict a non-paying tenant.
Yeah.
And this is what happens when you buy an investment property in we'll say, a non-landlord friendly community or city. And so this is it's unfortunate. It really is, because there's a lot of beautiful, hardworking, everyday Americans and Canadians that are, they bought one or two extra investment properties and they're just getting taken to the cleaner.
Yeah.
Not only that, they the rent control makes it so, like, for in Ontario, for example, 2.5% is the maximum allowable rent increase. So if somebody is paying $1,000 below market rent, you can only increase them by 2.5%.
Yeah.
And so the reality of this is that it's the government is putting they're forcing investors to provide, we'll say, very, very, like, almost free supply of rental homes. And so it's disheartening, and it's unfortunate, and unfortunately, it's getting a lot of real estate investors completely out of investing. And so this is where we've been a very good alternative. Many of them, they're saying they're done managing with their single family. They're selling them, or they're doing a refi, and they're coming in, they're partnering with us, and they're saying, "Hey, listen, like, I love that you're looking after everything. You guys are just doing everything, and I don't need to worry about, a tenant stop paying for rents. I don't need to deal with the light bulbs anymore,
Yeah.
going out." And so, um, buying in landlord friendly markets where you can evict on a non-paying tenant in 1 to 2 months, you can do a non-renewal for a tenant that is, let's just say, being very negatively impacting a community, loud music at night, just, making a mess with garbage around, like, for whatever it is, we just don't renew in these markets. Whereas, in in these tenant friendly markets, you have to do the renewal, it just rolls over. And so we like markets like Florida. We like markets like Georgia. So Atlanta, Georgia. We like markets like Charleston, South Carolina. We love these markets because they're landlord friendly. And what's really interesting, John, is that, some people would say, well, that's not good for the tenants. Well, we're huge on value. We provide a lot of value. So for us, it makes sense for us to be able to invest in these properties, provide more amenities, provide better customer service, because we know if we can go in there and do that, we can and provide more value, we know we're going to be fairly compensated. So it's like business, economics 101, right? You provide value, you get compensated. It doesn't make sense that you spend all this money and you can't get fairly compensated. And so this is a very, very good option now for investors coming in working with us that have been investing in these, we'll say, tenant friendly markets that have been taken to the cleaner. And now they have a viable option to be able to continue investing, because we know it's made more millionaires than anyone else, any other asset class, but to do it in a way that, supports our investors' goals.
Well, and you touched on it a little bit, but it's interesting because we've now seen in the U.S., right, states like California, New York, New Jersey, these kind of blue states, the more democratically led states that have rent control or more, tenant friendly laws. And the data is actually pretty clear that those markets tend to have higher rents. So that rent income ratio is much higher. Because if you think about it, what happens? Well, investors have less incentive to invest in that area. Developers have less incentive to develop and build new supply. And so often those markets are very supply constrained. And what happens when they're low supply? Price goes up. So it's kind of that idea, and I guess I'll just say, like, the cliche, but like the road to hell is paved with good intentions. It's this idea, like, I understand the thing, like, right, the middle class in Canada and the US and really across the developed world is struggling today, right? And I think more should be done about it. But this is a great example where you think you're solving a problem and you actually create a whole other set of bigger problems, which means, once again, LA is one of the most expensive cities. You just mentioned New York City is a great example. Now, not
Mm.
all of New York City is rent control, but a lot of it is. And it's 70% rent income ratio, right? And so, for us, it's actually, in a sense, a better environment for the resident in these quote unquote landlord friendly states, because there tends to be more competition, more supply. And in my opinion, a competitive market, it may not happen overnight, but the bad actors and maybe the operators that are just maybe jacking up rents and providing bad experience, the free market kind of takes care of them. It takes maybe a little bit longer than maybe others would like, but it's really clear to me that these markets are actually better for the residents because they're providing more options, more supply, which means a more balanced market. So, speaking of that, right, like data, right, it's going back to number 5, which is historical performance and how those markets have, kind of gone through maybe a downturn. So, one of the questions we look at, and you talked about it a little bit, going in and analyzing Florida and sort of saying, like, where are the rents and what happened in the past, right? Like we talked about that on a previous podcast. But when we look at a new market, going back 5, 10, 15 years, how did it weather the storm in the past? What's the population growth been like? Did occupancy and rents hold steady, or did they collapse? So prioritizing markets that show resilience under stress is a big part of what we're talking about here. So that's really the fifth and final thing. Kind of a bit of a bonus, though, is that often the big markets get the headlines, right? So even in our world, we'll get these various reports and it's like, what's happening in Chicago, what's happening in New York. But these smaller secondary and tertiary markets, I think Charleston, South Carolina is such a great example. They're actually performing better than most of these larger markets because, part of it was the great migration that occurred after the pandemic, where people realized, whether they changed jobs or their job allowed them to work remotely. And they said, well, why do it from New York when I can go live by the beach in Charleston and have a much lower cost of living? So there tends to be lower competition, less new supply. And then, if it's a market, for example, that there's a strong commuter base, right, can create a hidden gem, right? So some of those further out suburban markets that have, city centers that have a lot of quality of life that it provides, those are some markets we tend to look at as well. So it goes back to like Charleston, South Carolina, may not have been on our radar when we first started this, but when we started analyzing all the markets in the Southeast, it jumped out because it's just seen incredible population growth, but it's not like one that gets the headlines often, right? So those secondary and tertiary markets are great areas of opportunity.
Yeah, for sure. And this is where John, having our in-house team, it's worth its weight in gold, really, because markets do shift, and it's like a big puzzle piece. It's a big puzzle. I grew up with,
Yeah.
like, my parents were like, "You always love puzzles." I'd still like puzzles, kind of putting things together, right? That's what I
Yeah.
think having structuring and building a good team is like. It's really like a big puzzle, and it's the same with buying in and figuring out the right markets, because you can look at all this data, but then pulling it all together, that's something that the more experience you have with it, the better you are at identifying trends. And so if you can get ahead of a trend and be able to position yourself really well, you are able to get the benefit of that. And that's where John, having Joe Lowry, he has like over 1 billion in experience and acquisition. And so not only doing all the intel and the research, but then all the connections, the broker connections as well, and all the intel with all of the conversations that are that are being had every single day. And then Georgia, our asset manager, 20 years experience, $800 million portfolios where she had come from. And just knowing the markets, actually have been able to look after these these assets, these large multifamily assets, and seeing how different markets responded to the asset itself. And so in having that experience is really worth its weight in gold. And that's what really, John, at the end of the day, that's one of the key advantages that all of our investor partners, they get direct access to the best intel and data and the best team to be able to execute and really drive higher returns for them.
That's right. So just kind of wrapping up, right? Job and population growth are the biggest demand drivers. So we start there. Then we're going to look at affordability and laws that impact landlords directly, and that would affect stability and returns. And then obviously that historical resilience, just looking in the past to see how can we help use that data to better predict the future, right? So that's how we're applying these frameworks at Faris Capital Partners.
Right on. Well, if you want to learn more, guys, go to fulloutinvesting.com. You'll learn a little bit more about our 10-step full out investing process. There's also a sample deal on there as well. You can book a one-on-one call with us and find out a little bit more, if we're the right fit. If not, we always let our investors know, and we give them insights as to, perhaps go down this direction or this direction. We want to make sure that you're looked after. So book that discovery call today and find out, if we're the right fit. And if not, we'll make sure to point you in the right direction. Well, thanks for listening, guys. If you enjoyed the show, please share and subscribe to the channel. And I really appreciate you guys listening to the Multifamily Investor Playbook. We love and believe in you guys. Keep dreaming and investing big.